Hello and welcome, everyone. I'm Chris Kuiper, Director of Research at Fidelity Digital Assets, and I'm pleased to welcome you to the Value Exchange, a webinar offering a glimpse into the latest topics and events moving digital assets forward. In this episode, we have a very special guest today, Lyn Alden, founder of Lyn Alden Investment Strategy, who is also joined by our own Jack Neureuter, who is a research analyst here at Fidelity Digital Assets, and who I will say is the brains behind our research engine. Today, we're going to discuss key highlights from one of our latest research pieces called Bitcoin First. We'll explore why investors may want to consider Bitcoin separately from other digital assets. But I imagine our conversation will take us beyond just Bitcoin. If you're seeing some of Lyn's work or familiar with her work, you know Lyn is a true student of the markets, and Lyn possesses a keen sense of the macro landscape as well as monetary history. So I imagine we won't only talk Bitcoin, as I feel like it'd be like having a master Michelin-starred chef with us and only asking them to make a grilled cheese sandwich. So we'll certainly be asking Lyn some of the macro questions on our minds, and I encourage you to do the same in the Q&A. So that brings me to two housekeeping notes. Number one, the Q&A is open right now, and you have the option to submit questions anonymously. So just click the Q&A button on the bottom of your Zoom screen as you think of them or as they come to you, and then you can submit them throughout. We'll compile them at the end and get to Q&A in the last 15 minutes or so. The other note is that this session is being recorded and will be available as a replay following the event. And then finally, we will do just a very short survey at the end. So we'd appreciate if you stick around for just a few seconds and help us out by filling that out. So without further ado, let's get to it. Lyn and Jack, thank you for being with us today. Jack, we wrote this piece together, co-wrote it. So I'm going to take the liberty as moderator to just introduce the piece, spend a few minutes talking about what it is, what we covered for those who haven't had a chance to read it yet, or if someone's read it and just wanted a little bit of a refresher. And then I think I'll turn it over to Lyn for a few comments on the piece, what you thought of it, things we may have missed or could have gone deeper on. All right, so first of all, the piece is called Bitcoin First, Why Investors Need to Consider Bitcoin Separately from Other Digital Assets. And so this really came about as we saw and heard people go along their Bitcoin or digital asset journey, and they would get familiar with the technology, they'd get familiar with the idea of digital assets, they'd start to come around to the investment thesis, and they'd say, I need and I want exposure here. I'm comfortable with it. I've made the decision now to get exposure. But my next question is, what do I buy? There's Bitcoin, obviously, the first one, the most well-known. I know the second one, Ethereum maybe, but there's 1,000 other things. And so what we're proposing in this paper is, number one, we think Bitcoin is distinct. It is unique. We think Bitcoin is best understood as a monetary good. And what we mean by that is a good that has value above and beyond its typical use case purely as a monetary good. So people treat it as money because it has these good characteristics of money. And we go through that. It is scarce, it's divisible, it's portable, it's verifiable. And then the other thing we walk through is, okay, well, if it's money, why do you think it will be the dominant form of digital money? And we go through how powerful network effects are, how Bitcoin has already taken over the main space, the use case of a digital monetary good. And then the other things we often hear from clients or prospective clients is, I understand Bitcoin was first, but if this is a new technology, I'm going to look at it through a technological lens, which is the pioneer usually blazes the trail, and then someone else comes along and usurps them or supersedes them. So classic examples, we've seen Facebook come after MySpace. We've seen Google clean up after all of the search engines of Ask Jeeves or AltaVista or any of these other things that many people don't even remember anymore. And so while we think that point is valid for technological innovations, you have to understand why money is different, right? And so we go through and explain why we don't think that will be the case and why Bitcoin is, once again, unique. And the other thing we often hear too is, well, Bitcoin was first, so it's captured a lot of its value already. It's gone from literally nothing, a collectible, an experiment, to this nearly $1 trillion asset class. So how much can actually be left? And if I'm going to allocate to this space, why am I not going to look at some of these other newer, more exciting projects or tokens that are much smaller and therefore potentially have a lot more upside? And again, we're not discounting this idea. Maybe there is more upside in these other projects. But the other thing you have to remember is that a lot of the risk has been taken off the table with Bitcoin. So perhaps compared to a brand new token that hasn't proven itself yet, there is more upside there, but there's also a lot more risk. And so we think investors have to have kind of a venture capital like lens when they look at these projects. So those are the things we wanted to accomplish in the paper. So Lyn, let me turn it to you. What did you find interesting in the paper? What are some things that you'd like to add, or things you thought maybe we got wrong or missed or didn't go deeper on?
I think that's a great summary. And overall, I love the paper. I think it's one of the best papers published on this topic in a long time. And, Fidelity it's fascinating how early Fidelity was to this space. And so, I've cited Fidelity's work a number of times because they brought an early kind of credibility to the space. And I think the paper continues that trend. And so I really don't have any sort of disagreements with the paper. I think there's always places that can be fleshed out more, right? But that's not a criticism of the paper, because if you make the paper too long, nobody reads the paper. And so you want to have that balance between detail and covering the topic in a concise format, and diving into future subjects can always be done in future research papers. So I think there are topics you can go into, like, what is money? Essentially, you can kind of back up and go back to first principles and kind of talk, basically the whole paper is about why Bitcoin is different from some of the others. You can always flesh out more about what is money. All right, the paper touched on that, but that, you can write a whole book on that, right? So you have to know when to cut it off. And I think the paper did a good balance between covering the topic with a sufficient detail, but also being concise enough that it's easily digestible.
Yeah. So on that, I would be curious to hear from you, Lyn, as someone who's studying these things. And you're right. It wasn't the point of the paper to fall down that other rabbit hole of what is money. But I would be curious to hear from you. If someone were to ask you, what is money? How would you think about this, and how would you answer that?
I would say it's essentially a fairly high stock to flow asset that, is basically the most saleable good. So historically, that meant the commodity with the highest stock to flow ratio that was durable, divisible, liquid, fungible, all these characteristics of money that the paper touches on, and that can survive technological innovations that make it easy to produce more commodities. And so really gold, and to a lesser extent silver, are the only types of metals that have really managed to maintain a high stock to flow ratio, even as our technology's gotten better and better at harvesting all sorts of commodities. Fiat currencies have been another kind of introduction to money. They are interesting because they have higher stock to flow ratios than most commodities, right? So lower than gold, maybe comparable to silver, but higher than most other commodities. They're legally enforced. Their volatility is managed by the government and the central bank, and so they've kind of filled in that role for quite a while. One way you can separate money and currency is to say that basically currency is a medium of exchange, an asset that's also someone else's liability, right? It's the liability of the central bank, whereas or commercial banks, right? So there's different types of money. There's base money. There's physical money. There's broad money, right? So it's someone else's liability in one shape or form. Whereas if you get down to actual money, it's basically a good, a saleable good that is no one else's liability. So that's historically been gold. That's why central banks hold gold. It's one of the few assets you can hold reasonably well that's no one else's liability. You own it free and clear. And you can also throw things like silver and Bitcoin, right? Basically these assets with monetary properties that are not someone else's liability.
Oh, that's interesting. So one of the questions we get then, and I'll pose this to you, is as you've kind of put Bitcoin against money, currency, fiat currencies, how do you think this plays out? Is there inevitable competition? And the real Bitcoin bulls, the maximalists out there, will say, they'll look at all these characteristics, some of the things you've mentioned, and they'll say, well, obviously Bitcoin is inevitable. It's going to beat all these other things out on all these metrics. Therefore, it's just a matter of time. But I'd be curious to hear your view there.
So I think anyone, basically that wants to manage risk has to be careful with words like inevitable, right? So because that can dictate position sizes, that can dictate long-term planning around our finances. And so I don't really view anything as risk-free or inevitable. I think the best way to describe it is, and you talked about this on the paper, the Lindy effect, right? So Bitcoin is a 13-year-old asset. And so far the characteristics appear as though they are, a superior monetary good to many other types of commodity monies out there, including gold in many ways. But it's a 13-year project so far, we haven't fully tested every conceivable aspect of this in a similar way that, humanity has grappled with gold for thousands of years, right? We've still not been able to, increase the stock, decrease the stock to flow ratio of gold. We don't know how to just make a ton of gold. We don't know how to do alchemy. We tried alchemy, we can't do it. We tried all these different ways to mine it. Basically, except for when we discover a new continent, we have trouble getting a lot of new gold to the market at once. And so that's got that long-term history. Bitcoin so far is going on this accelerated path. We've kind of discovered and invented a new monetary good, a new way to store and transfer value around the world. But we have to watch out for technical bugs. We have to see how does it survive against thousands of competitors. What happens when it gets big enough that some governments want to ban it? What happens if bigger governments try to ban it? Can it get big enough so that it becomes unbannable? And so we're still grappling with certain kind of adoption characteristics, but I would say that, if it avoids major tail risks, the longer it goes, the more monetary it becomes, the more inevitable it becomes. But that's always like an asymptotic relationship. It can never completely hit 100% inevitable. Just like how if I were to say, if I was holding gold right now, it's obviously one of the most secure assets you can hold. But you have to have the caveat of what if Bitcoin does do really well? Would gold become less interesting for some investors, right? So every asset, no matter how reliable, always has some caveat somewhere for what could change it. You always have to be aware what could change this asset.
Yeah, absolutely. And some of the risks, Jack and I continue to point out bugs. The Bitcoin code's been looked at and poured over, and there's obviously a huge incentive and bounty for someone to do that. But we have to be honest with ourselves. We don't know if there's some angle that some very clever programmer is going to find and exploit someday, even if it's not for financial gain, but just for someone that wants to see it implode or burn. But Jack, another question we get with the paper is, okay, so let's give you that Bitcoin's a monetary good, and these other digital assets serve different purposes or use cases. How does Bitcoin play into that? Where does it stand relative to that? And we do kind of you wrote two hypothetical scenarios. So I'm wondering if you could just explain those scenarios for us.
Yeah, Chris, I think you talk about Peter Thiel's like 0 to 1 idea of once it's invented, like the genie's out of the bottle, and even with Bitcoin, it's open source code and anybody can copy it, but nobody's been able to take Bitcoin's code and recreate it on their own. It's always about the trade-offs that Bitcoin makes, and with Bitcoin, it's sort of taking positive attributes of gold, like Lyn is describing, scarcity, durability, and then taking positive attributes of digital fiat, right, in an increasingly globalized and digital world, and putting the two together. And it does so through sort of emphasizing decentralization and security at the explicit cost of scalability. And I think if we follow sort of the evolution of the digital asset ecosystem through time, the period of like 2009 from when Bitcoin first launched through 2015 was largely just Bitcoin sort of becoming an asset into existence alongside a bunch of sort of copycats that just took Bitcoin and was like, okay, well, we'll make it more centralized and scalable, but it didn't bring anything meaningful to the table. And that, I would argue, sort of changed in 2015 with Ethereum, where instead of making an asset more scalable, it was, let's make it more functional, right? And this, we think of like smart contracts being added. And this is where we start to see maybe potentially different use cases emerging beyond just trying to be only a monetary good. And I think that's where we start to see this distinction of like, okay, it's not necessarily mutually exclusive. Bitcoin can be successful on its own, and you could potentially have other digital assets that also serve other use cases, or at least other primary use cases outside of being a monetary asset. And so that's where we start to paint these sort of two worlds, one in which Bitcoin is sort of a monetary asset in both worlds because of the trade-offs it makes. It has sort of that absolute scarcity enforced the greatest, right, because of its decentralization and security put forth. But it could act as sort of a non-monetary or a non-sovereign monetary good in a world of multiple digital assets with different use cases, or it could be a base layer in which you build things like the Lightning Network that are showing sort of promise to be able to scale Bitcoin and make it more functional without altering the base layer and making those trade-offs.
Yeah, absolutely. So the two, to kind of summarize, the one where Bitcoin still stands as its primary use case as a monetary good, other things are being built over here in separate networks or silos, that's fine. Or things get built on top of Bitcoin. And so the value accrues to Bitcoin as things like the Lightning Network get built on top. Lyn, I'm curious to hear how you think of this. I know you've also studied and written about Ethereum and perhaps maybe some other digital assets. How would you view these non-Bitcoin projects in relation to Bitcoin?
So I view Bitcoin as essentially the recreation of a digital commodity, right? So compared to, we've had this kind of, in many ways, that the banking system is kind of a proof of stake system, right? And so Bitcoin actually came in and reintroduced proof of work, basic commodities in digital form. And it's inevitable that once that happened, we said, okay, how can we make equities in digital form? And so I view many of these other platforms as essentially digital native equities. And the market's still exploring to what extent it wants them to, basically decentralization has a cost associated with it. It's often less efficient. And so we're the market is kind of exploring where do we want decentralization versus where is it not needed. And I think money is the killer app for decentralization. And then the question is, what else, if anything, should we apply it to or try to apply it to? And so I view, most of those other ones, maybe you can put Litecoin and other ones like that in Bitcoin's category of a digital commodity, but the vast majority of them I would classify as more like digital equities, where they're competing on their technological merits, the desirability of using their ecosystem compared to a competitor's ecosystem, and they make more trade-offs, they have more centralization in exchange for more expressiveness. And so if you look at, for example, DeFi total locked value, in the beginning of 2020, mid 2020, something like that, Ethereum had up to 97% of DeFi total locked value. And last I checked maybe a week ago, it's down to 59% as you've had this flurry of new competitors. It still has something like 90% of NFT market share. There's, less fee sensitivity there because it's lower velocity. But overall, I kind of classify all those types of systems as these operating system-like competitors, these equity-like operating systems. And so a key aspect of technology that has to innovate quickly, be willing to break things and reinvent things, whereas a key aspect of money is stability and basically long-term assurances for what it's going to be like. And so I put those in two different buckets. You have Bitcoin and maybe a couple others like Litecoin in one category, and then you have all these smart contract platforms in a very different category.
Lyn,
Yeah, go ahead.
Lyn, would you agree with the idea that non-Bitcoin digital assets, particularly those that are like Ethereum, competing with to be other layer ones with smart contracts integrated, are competing with the infrastructure and scalability things being created on top of Bitcoin? So it's almost like the infrastructure being built around Bitcoin would be competing with these sort of non-Bitcoin digital assets in some ways, rather than directly competing with Bitcoin.
I view it like that. Yeah, essentially, I don't really view proof of stake smart contract systems as competing with a simple proof of work based layer. But yeah, I do think there are in direct competition with some of the above layers. And so far, I mean, obviously, Ethereum and some of the others have been the key winners in terms of getting all that liquidity on it. Partly it's culture, right? So some blockchains have different culture around the idea of trading, leveraging, speculating. That's been most of the use case for things like DeFi and NFTs, whereas the Bitcoin community is obviously more single coin focused. And so there's less inherent desirability to have exchanges, decentralized exchanges or leveraging protocols. But overall, long term, I think we have to watch things like Lightning, watch things like Liquid, watch things like Rootstock to see to what extent Bitcoin's higher levels will compete with those others, because essentially we have kind of a difference in technology view. So one idea is to expand expressivity on the base layer in exchange for more technical risk at the base layer, less decentralization to the base layer, less auditability of the base layer, but a lot of efficiency. Or you keep the base layer really solid and build it up in layers. So for example, our financial system operates in that layered approach, right? So we have underlying large settlement transactions, and then we have layers like Visa that run on top of those. And so I think that approach makes a lot of sense, but the market's still sorting that out. So we as you pointed out earlier in this chat, multiple coins have come along and try to take Bitcoin and say, what if we make it faster? What if we make it more scalable? And so far, those have all failed to catch on, partially because of what defines money in terms of hardness. And the one that the market's still kind of sorting out is how much expressivity do we want on the base layer? And so I think that still remains somewhat of an open question.
Yeah, so that's an interesting point, this idea of competition for these things. And I think hearing you talk about the separate bucket and Bitcoin being the most decentralized, so therefore money's the killer app, that's what you want. That's exactly what we've talked about in our work in our paper. But I guess to play devil's advocate there, what if someone were to say, well, that's fine, but who's to say the market doesn't want the highest level of decentralization for money? So just as a theoretical here, many people, especially in the DeFi space, treat Ethereum as money. To them, Ether is their base money layer. So is there a scenario, if I had to poke a hole in our thesis here, is there a scenario where people gravitate around something like Ether, let's say, knowing that it's not the most censorship resistant or decentralized compared to Bitcoin, but it's good enough and it's got these other things. Therefore, they just start treating it as money, and we can say whatever we want of what we think should be money. But if the market treats this other thing as money, doesn't matter then.
I think it's possible. So one way to look at it is the relationship between the dollar and gold over the past 50 years. I mean, gold is unmistakably a harder money, right? It's got the average, inflation rate is estimated to be on average 1.5% per year, fluctuates in a very narrow band between 1 and 2% per year, meaning the amount of new gold that is mined compared to the estimated existing stock in various forms, versus the dollar, which has gone up in supply a lot more quickly, and it has devalued against gold. But still, the vast majority of people hold more money in dollars than in gold, and the same would be true for euros and yen and things like that. And so basically you can have, and that a lot of that's due to legal force, right? I mean, basically it's legal tender and it's volatility controlled, and so it's what we pay our taxes in. So it's not necessarily what we would gravitate to on our own, but it shows that if you get a number of things in place, you can have a lot of people treat a softer commodity as money compared to a harder commodity, and so it's certainly possible. I would say that so far Ethereum's been having some of a trade-off between terms of making its money appear harder versus having its ecosystem be the most attractive to use. And so as Ethereum's kind of tried to harden itself to some extent in terms of say its inflation rate, you've had kind of these other competitors that are able to have more throughput, lower fees. Some of them in exchange for more centralization compete with it. And so I think ultimately, to what extent Ethereum's successful will be less about how attractive it is as money and more about how desirable its ecosystem is compared to competitors. And so, for example, if we look at Apple stock, right? So Apple reduced their share count from 26 million to 16 million or so over the past decade. And that's obviously been very strong for the stock price. But ultimately, at the very long run, the success of Apple, the market cap of that company will depend on the desirability of their ecosystem compared to competitor ecosystems, right? So to what extent is their hardware better than other hardware, and then to what extent is all their software and services that run on top of their hardware ecosystem more attractive than competitors? And that's the long run arc of what will make Apple successful or unsuccessful, more so than how many shares it buys. We can see that, for example, with IBM, it buys a ton of shares over the past decade and doesn't really go anywhere because its ecosystem is not retaining the share compared to its competitors. And so I view Ethereum in a similar boat. And we saw a recent example where Terra, right? So Terra's one of the competitors to Ethereum in some ways. It's rather unique. So it's not a clean competitor like Solana and Avalanche are. But if you look at Terra, they have this algorithmic stablecoin, and there's always been concern. So far it's been arguably the most successful algorithmic stablecoin, but there's always concerns about the potential for a bank run or a death spiral. Basically, it works really well. It could be like a Thanksgiving turkey where it works, really well all the time, but then it has one catastrophically bad day where it just kind of has this death spiral. And so one of the recent actions their ecosystem has taken to reduce the risk of that is to build $1 billion Bitcoin reserve. And so, they didn't choose Ethereum, they didn't choose Solana, they could have chose any number of their competitors to hold their assets, but they chose Bitcoin because if you had to say, okay, what is likely to hold its value, or at least what is likely to be a strong ecosystem 10 years from now, what is likely to not have catastrophic bugs, none of them have a 0% chance, but it remains the case that Bitcoin has kind of the simplest and cleanest and most optimized store of value out there for compared to the other tokens, is the one that you choose when you need to put $1 billion somewhere and lock it up for a number of years.
That's an interesting example. I hadn't heard that one before, but it's a better example than what we came up with in the paper, I think, Jack. I think I gave the example of those two scenarios. How do these separate silos tie their value back to Bitcoin? It's like they need to be able to convert, or in this case, have a reserve of Bitcoin, because that's the ultimate monetary good store of value in this new digital asset ecosystem. And the example we used was an arcade. So you take your monetary good, your US dollars, and you trade them in for these arcade tokens, which by themselves are, cost pennies to produce. They're just a base metal or maybe even plastic or something. But they have value in the ecosystem of the arcade, right? But as soon as you take them out of that ecosystem, they're basically worthless. So you need to have a link to that monetary good. And so that's a great example. Turning a little more towards the macro front now. So it's clear, at least maybe up until the last week or so here, that Bitcoin's correlation was greatly increasing with risk-on assets, especially tech stocks. Jack, given our assertions in Bitcoin first, do you think this correlation continues? Is this the new normal for Bitcoin?
Yeah, I think we saw this flip in 2020, which makes sense, right? Prior to 2020, throughout Bitcoin's history, its volatility, if you look at it on any sort of normal rolling period, 30, 60, 90 days, was bobbed between negative 0.5 and 0.5, which you'd expect for an asset that is supposed to be uncorrelated. But since 2020, what did we have happen? That was the year of the halving. That was the year of corporate treasurers really coming out and talking about adding Bitcoin to their balance sheet, hedge funds coming out and saying this might be a legitimate asset class that we might trade. And it makes sense that it would start to become correlated, as it's still a relatively nascent asset, that it becomes correlated with risky assets in the short term. And I don't think that it's unreasonable to say that might continue until sort of the narrative shifts. And I think eventually that narrative will shift towards, okay, well, this isn't just a risk-on asset. This is actually like, a macro asset, a digital gold that has supply constraints. And therefore, over time, right, if we think longer term, what matters to Bitcoin's success isn't what matters to the S&P 500 necessarily. It's more about the adoption curve, the growth of the adoption curve, the infrastructure being built around it. And I think all of those things start to sort of take hold over time as the narrative shifts from maybe Bitcoin being just a high beta tech stock to this uncorrelated macro asset that matures.
Yeah, curious to hear your thoughts on this as well, Lyn. As more of an active investor who writes on this, how are you looking at it? And this gets to some of the questions we're getting in the queue as well of, its role in a portfolio. Does it truly provide diversification, or should we expect it at least to provide diversification?
Yeah, historically, the correlation's been somewhat mixed, but ever since early 2020, most assets in general became more correlated. And as Bitcoin has kind of ascended to, institutional level adoption, I think that correlation has increased to some extent, pretty substantially. Now, you can always have these kind of periods of temporary correlation. Like, so for a while, Bitcoin was correlated to the 10-year treasury until it wasn't, right? So you can have these periods of strong correlation that eventually break down. And so if you start to get, for example, margin pressure on companies, that's where commodities can break out relative to stocks. Whereas what we've seen recently is that stocks and commodities have often gone up together. Another thing to look at is that because Bitcoin's a global asset, it's owned by people around the world, it's less correlated to other stock markets than the S&P 500, right? So, if you're in Russia right now, or Ukraine, it's not correlated to the Russian stock market, right? You'd want to hold things like gold, Bitcoin, or dollars. I saw a study that showed something like that among Russians that own stocks, they have 95% of their stocks are Russian and 5% are international. And that's been devastating for them in recent weeks. But people that hold dollars, gold, Bitcoin, silver, Ethereum, things like that, I mean, that's been uncorrelated to their home investment. And you have a less extreme case, but China, Brazil, many European markets, right? So it's been a lot less correlated to those global stock markets. And so I think when we think in that broadened term, that for a lot of pools of capital, yes, Bitcoin can provide a degree of a lack of correlation. And in addition, even if it's correlated, if you're bullish on the asset, you then might select it over other assets that it's correlated with if you think that in the long run it'll be superior in terms of performance, right? So, you can have, let's say you have a slot where you want tech growth exposure. Now it's tricky because we talked about how Bitcoin in many ways is more of a money than a tech, but it's still due to the volatility and due to the growth, it still kind of trades in many ways like a tech stock. But you can say, okay, do I want Bitcoin or ARK, for example? And you might look over this period of time and say, okay, they've been somewhat correlated, but Bitcoin's been a better performer. And so you might go with Bitcoin over ARK, or you might, instead of going entirely into ARK, you might say let me split it between Bitcoin and ARK. And so I think it's the combination of one, uncorrelated assets, and two, just a selection of which assets have the best chance of providing good long-term returns. And so that's how I view it.
Yeah, that's an interesting thing. So number one, I'm hearing broaden your view of what it's correlated to. And I didn't know the stat on the average Russian investor, but even in the US, I've seen similar statistics that there's home country bias everywhere, right? Even in the US, people are more overweight to US companies than they should be if they were a truly neutral, passive, equal weighted in terms of how stock markets make up the total market cap combined. And then number two, to your point, okay, maybe it has the same correlation, but you swap it out so you haven't lost anything in terms of diversification or haven't gained anything, but you've gained much more upside or reward. So going big now, I'm curious, since you write a lot about monetary history, you have this great way of breaking down these century-long trends. Could you give our listeners kind of the layman's term of how we got from, say, early 1900s and the big changes? The international monetary system has been kind of reworked a few times, some landmark key points there. What happened and how did we get to our current state? What's our current state today? Especially, I'm thinking of, as you talked about, how dollars and gold are now competing with each other. How did we get here?
I think there are two paths we can go down to look at that. So the first path is kind of the transformation of what we view as money, right? So is throughout history for thousands of years, we've had commodity monies, and you've had all different ones, and eventually it kind of consolidated towards gold and silver as the hardest or highest stock to flow commodities among the most durable. And eventually, with the invention of telecommunications channels and banking, gold really won out over silver, because the one disadvantage gold had relative to silver was it was less divisible, right? So even this tiny gold coin was worth more than like a week's labor for a typical person. Whereas when you actually then say, okay, gold, this dollar is backed by gold and the dollar is super divisible, you've essentially fixed, quote unquote, fixed gold's kind of one shortcoming. It's now more portable, more divisible. Two banks can, quote unquote, send it to each other right away across the ocean. And so by updating their ledger. And so we went through this period of obviously gold-backed fiat currency, right? So it's gold-backed paper currency. And then as the world fought a number of wars, starting with World War I in particular, but then going into World War II and all those others, we eventually dropped that gold backing and shift towards what has in some ways been more oil backing. So the United States kind of, in some ways, it made deals with OPEC and other countries to say, okay, only sell your oil in dollars. And that basically makes it a situation where every country in the world that needs to import oil needs dollars. And so many of them hold dollars as a reserve asset. And so we've had this 50-year fiat currency regime. Another way of looking at it, the other path, is kind of the Dalio approach, the long-term debt cycle. So I've kind of read his research over the years. I've added to it by kind of doing my own analysis and number crunching and charts. And essentially, the idea there is that you have a business cycle, a short-term business cycle. We have expansion in debt to GDP, and then you have some sort of deleveraging event, some sort of external shock, some sort of malinvestment that gets wiped away, and then you start the next cycle. But the challenge is that because of policy response and because of the nature of how we've operated the system, you don't deleverage all the way. You deleverage part of the way and then start building up leverage again. And it's, when you cut interest rates and you raise the interest rates and you cut them, when you string a bunch of these together, you get higher and higher debt to GDP and you get lower interest rates. And so that's what he would call the long-term debt cycle, which is different than just the 5 to 10 year credit cycle. And the challenge is that when interest rates get to zero and debt gets extraordinarily high, that system starts running out of room. They've kind of kicked the can down the road very, very far. Then they have to turn to other types of policies. So they result to QE, or they result to helicopter money. And the main difference between say a long-term debt cycle being resolved versus normal credit cycle is that they're often associated with currency devaluations, right? So for example, if you look back in the 30s and 40s, that's the last time we had this type of long-term debt cycle unfold. And in the 30s, you had a devaluation compared to gold for the dollar and for every other major currency. And then you also, in the 40s, you had inflation run very, very hot, and yet you had central banks hold their interest rates near zero anyway. And so anyone holding cash and bonds essentially got devalued, right? So it's less so for the winners of the war, more so for the losers or the more damaged ones in the war. But you had this kind of 1-2 punch in terms of currency devaluation. And the challenge is that we're kind of in that sort of environment now, just hopefully less extreme. And so that's how I'm interpreting it. Basically, with super high debt levels, entering a more inflationary regime of commodity tightness and things like that, we have this unusual decoupling between inflation and interest rates. And so that's the big macro framework I look at now, and that's the kind of environment that people start looking around and they say, well, what is a scarcer type of money? So if I'm not getting paid to own this looser type of money, what are these alternative monies? So they can look at gold, they can look at Bitcoin, they can look at commodities in general. And so I think that that's somewhat of a regime shift compared to the past 40 years, where risk parity or 60-40 portfolios were supreme.
Yeah, Jack, I see you nodding your head. This sounds a lot like what you've written on and talked about. Can you elaborate too why you also think our current situation is looking a little untenable, or some of the headwinds we're going to be facing, and how Bitcoin plays into that?
Yeah, exactly. And Lyn just basically, summarized it 10 times better than we ever could. But, I would say we similarly agree with a lot of those points that you make. And I would zoom into like the last 40 years. One of my favorite charts is just the 10-year treasury yield from 1981 through today, because it's a linear line and tells a great story that it's a system, that investment portfolios, as well as sort of the economic system as a whole, has been sort of levered and levered to these ever lowering interest rates, right? We've gone from over 15% in 1981 in a near linear format down to, sub 2% today on the 10-year. And, the dollar has sat at the center of the system this entire time. And as Lyn mentioned, we've never truly deleveraged, but we've had major events, 1987, 2000, 2008, and 2020, which stand out as sort of increasing, policy intervention from both monetary and fiscal policymakers. In sort of 1987, you get the Greenspan put, right, which is the start of it. 2000, post 2000, you get a little bit of monetary intervention. 2008 is when you get quantitative easing as well as some fiscal spending. And then 2020, right, monetary and fiscal working hand in hand, bigger than ever. And it's like, this isn't really a coincidence. And you start to look at the system and the structure of it. And what stands out, as Lyn mentions, is the level of global sovereign debt relative to the underlying economies that finance it. And you start to ask the question of, okay, well, how does that normalize, or how does that play out? And the probabilities start to shift around in terms of, we're looking at, forward expectations. And I think Lyn points it out, is like period like the 1940s. I think in our view, the probabilities are sort of shifting towards central policymakers continuing to step in and maybe, some form of financial repression, which obviously, if we think about, winners and losers, it's never absolute, but if financial repression is, sort of has probabilities tilted its way, what works well in that environment? Scarce assets, right? We think of real estate, precious metals, and then we can sort of walk that logic forward into, well, scarce digital assets that are emerging. Well, that might be an interesting hedge. And then what, maybe is facing some headwinds in that type of an environment, probably cash with duration, fixed income.
Yeah. Lyn, how do you see this playing out? Is it the same as the 40s, like you mentioned, or is this time different? And perhaps as an addendum to that, what's different this time with the US as the global reserve currency? Is there a threat to that? And how does that even work? I mean, what comes to replace it, or what comes alongside of it? I know a lot of people pointing out Powell's comments yesterday, noting that you can have more than one reserve currency. How would that exactly look to you?
So I think historical analogs are useful, right? Because they give us a baseline to operate from. There's no period that's identical to another period. I mean, technology alone is radically different. Our cultures are different. The world's different. But it allows us to view things as less unprecedented. History goes through these big cycles, and so I've been making that comparison for the past couple years, and it's really been a useful tool to be less shocked by some of the things we've been seeing over the past 2 years. A lot of people are describing this as unprecedented, or how could this happen? And it's like, well, if you were kind of studying that history, that was one of the few places I was lucky to come across a number of thought leaders that kind of, over the past several years pointed me in that direction. And so I was lucky enough to be aware of that, because that's what allowed me to navigate this environment where, of course, you're still shocked by certain things, but you're less shocked if you understand the historical analogs. And then the question becomes, how are they different than those analogs? And so a key thing to focus on is, in some ways, the United States looks more like the United Kingdom in the 1940s than the United States in the 1940s, right? So, so the UK was the existing power. It was running a trade deficit. You had America was the rising power, right? So we were faster GDP growth. We were a big exporter, right? We had cheaper labor. We had just more abundance in general. And so eventually started to see a distribution of the type of reserves that different entities were holding. And eventually that shifted over to the dollar, but it wasn't just one event. And we didn't fight them in a war in that time, right? I mean, they were on the winning side of the war too. They just were happened to be more harmed by the war. And so it was a process where you had global reserve currency kind of shifting from the UK to the US. In addition, you still had gold as a key underlying asset, which is true today as well. And so when we look at today, the United States is what makes us different than the 40s is that back then we had structural trade surplus. Now we have structural trade deficit. And we have obviously, the whole world has slower GDP growth, slower demographics growth than they had back then. And so I think as we go forward, we do have to watch this relationship between the United States and China and some other currency areas. And so I think that, what made the post-World War II era interesting, mostly in a bad way, is that much of the world was devastated. And so the United States was like over 40% of global GDP. And then when we dropped gold from the dollar in the 70s, we were still over 35% of global GDP, and we were the world's biggest commodity importer. And now China is the world's biggest commodity importer, and the United States is down to, depending on how you measure it, that 20 to 25% of GDP range, and generally with a downtrend. And so as we kind of look out, we should expect to see a somewhat more decentralization or more kind of a multipolar world. And I think some of, I've been writing about those trends for the past couple years, but I think that recent events may have accelerated some of the decoupling or some of the multipolar tendencies that we might be seeing going forward, where, say, Russia and China maybe have their own payment channels versus the West and their payment channels. And I think we have to be aware of the risks around kind of a fracturing. Instead of having just one reserve currency, you can have a number. In some ways, we already have, the dollar and the euro is kind of the main currencies. One's obviously more dominant than the other, but you can have a spectrum. And it's interesting, actually. Jerome Powell actually said this in Congress just in the past couple of days. He said there's intrinsically nothing stopping there from being more than one global reserve currency or global reserve asset. And so I think when you have a combination of major currencies, and then also major assets, gold, and then if it gets large enough, Bitcoin, right? It's premature now because we're talking about, less than $1 trillion asset. But basically it's like looking at the broad array of assets, saying, okay, what are the major currency players? What are the major payment channels, either in development or being developed, or already launched and just not being heavily used? So what is that field? And then what are kind of the hard assets that central banks can hold if they want, self-custodial money?
Interesting. So we're going to move to some of the audience Q&A. Before we do that, and as I compile some of these, Lyn, I know many people listening today are eager to hear more of your insights. What are you working on next, and where can people go to find you and your work?
So I'm at lynalden.com. People can find my work there. And the next piece I'm working on is a long form article on what is money, essentially. So kind of it actually would go along well with that paper. And I actually plan to reference your paper in it because it happens to tie so well into it. And so it's basically this long form, but kind of historical view of what is money, why do certain monies win out over other monies, what makes a money inherently attractive, well, what does it mean to have a monetary premium over the utility value of a money, and how this relates to digital assets in multiple forms. So Bitcoin, central bank digital currencies, stable coins, kind of the full array of possibilities going forward.
Excellent. Well, we'll certainly be on the lookout for that. So let's get to some of the Q&As. I think we've answered a couple of them. One on the correlation. We touched on that. Jack, maybe one for you, a question on, we make this big assertion today and in the paper about Bitcoin being the most decentralized, but someone has the question of how should we view centralization in terms of large players, sometimes we call them whales, accumulating more and more, as well as the idea of these centralized mining pools that can get bigger and bigger. Is Bitcoin as centralized or decentralized as we think?
Yeah, I think part of the beauty of Bitcoin in particular, because it's not a proof of stake asset, is that having more coins doesn't necessarily give you more power over the network, right? It doesn't give you any more power over the network. Everybody's opting into the consensus rules, and those consensus rules are controlled by both mining operations as well as node operators. And so, of course, that sort of distribution of coins comes into question when we start talking about like Gini coefficient and the distribution of Bitcoin. I think it's important to note that like Bitcoin doesn't pose a game of equality. It poses a game of equal opportunity, right? Where everyone that's opting into that network it's effectively pure capitalism, where if you're opting into that network, you're opting into the same rule set as everybody else. And therefore, right, just because somebody has more coins than the other one doesn't mean they have more say over the network, but they do have more wealth, relative to somebody that holds less coins. And then to the point about mining, I think mining distribution certainly was more of a question back when China, right, had 60-70% of hash rate. But I think now distribution has actually increased from a decentralization standpoint. But again, it is something that I think is often talked about, and like you could put it in the risk category of something that theoretically could be a risk, but I don't think today is reasonable to bring up as a huge risk.
Yeah, for sure. So a lot of questions being spurred, I think, by the recent geopolitical tension. So we don't need to get into that. That's not the point of this webinar, but I think it does raise a good point. And I think someone asked a question about counterparty risk, and another person referenced your tweet, which I also saw. Love for you to expand upon this as well, where you talked about in your notes the difference between assets that are concurrently someone else's liabilities and some that are not someone else's liabilities. And how does that play into this geopolitical picture, or some of the things we should be watching for?
Sure. So the vast majority of assets, especially securities that we deal with, are they're assets for us, but they're liabilities for someone else. And so that includes equities, it includes debt, various debt instruments, bonds, things like that, and it includes currencies. They're either the liability of the commercial bank if you have a bank deposit, or they're the liability directly of the central bank if you're talking about, for example, paper notes. And so all of these assets have a direct counterparty, even if you're self-custodying it, like physical cash, where that party could choose to default or otherwise freeze your ability to use their liabilities as your assets. And whereas there are rather a small number of assets that are not someone else's liability. And so the obvious example would be gold. Whereas if you hold, say, some gold coins in a little safe in your house, those are assets for you that are liabilities for nobody else. And the same can similarly be said for Bitcoin. Obviously, as you talked about, it's a newer and more volatile version of that. But essentially, if you hold private keys, it's an asset for you and it's a liability for nobody else. And that discussion got accelerated, I think, to some extent when you see, central banks having their FX reserves frozen, right? So you could even say it's the right decision by some countries to block off another country's, assets due to an act of war. But if you're their perspective, you're kind of just discussing what is the nature of money. That distinction now became more clear because Russia, for example, they still have access to their self-jurisdiction gold reserves. It kind of shows why they've been building so much gold, whereas a lot of their other assets are frozen, and that can happen to another extent in someone's country. So we live in kind of a developed market bubble, but a lot of the majority of the world's population lives in emerging markets or developing countries, depending on how you want to classify them. And many of those people have these, these periods of hyperinflation. They have these periods of currency debasement. They have, weaker rule of law that can have their bank accounts frozen or confiscated in various ways. And so there are, assets that you can hold that are, for you and not a liability to someone else. And, real estate falls into that category as well. But of course, with the caveat that real estate is not mobile, it's not liquid, it's not fungible. And so when you actually get down to it, there's a rather small number of assets that are liquid, fungible, monetary type of things that are, money rather than currency in the sense that they're assets but not someone else's liability. And so that's relevant for central bank reserves. It's relevant for anyone who doesn't have 100% conviction in the rule of law of their jurisdiction. So, it's something that when we talk about total addressable market, it's worth being aware of that distinction.
Yeah. So, Jack, we talked a little bit in our research and especially when we looked at our retrospective review of last year and looking ahead to 2022 about this game theory at the government level, right? Could you explain what we mean by that and maybe some of our things that we wouldn't be surprised to see because of that, shall we say?
Yeah, I think that, obviously El Salvador sticks out as sort of the country that has, gone all in on Bitcoin, right? Where, they've announced it as legal tender, they've, removed any taxation associated with it, made businesses sort of opt in to have to accept Bitcoin. And I think that maybe stands out as a case of like, there's a first mover in a, that existed in a system where they're a dollarized country, and so they don't have control over their own currency, and therefore you sort of have less to lose, right? And that's sort of what you would expect for a first mover, right? Because there's no denying it, it's risky to make that that bold of a move. And I think that it's something that other countries that are similar and that are competitors, you sort of start to build out this game theory or of like a prisoner's dilemma type scenario. If it's working out for El Salvador, right? And maybe it's too soon to say whether it's working or it's not working. But over time, we'll see, right? If it's working out for El Salvador, then you would expect other countries, similar and direct competitors to be thinking about, building regulation and potentially copying some of the playbook that El Salvador has shown. And I think more broadly, right, because El Salvador is a country, I live in Massachusetts, and there's more people in Massachusetts than there are in El Salvador. So it's a micro example, not to to say anything bad about El Salvador by any means. It's really cool to see, but it is, it's not a massive developed nation adopting Bitcoin. But what we have seen is this trend of large developed nations, at least rumors of potentially over-regulating or banning. And a lot of those rumors have sort of flipped to, okay, well, let's properly regulate and properly tax, because if this really is an asset class that's only 2 trillion in size today, but is likely, on somewhat of a promising growth trajectory, that maybe we should attract capital, attract that innovation within our own borders rather than push it away, because we can't shut off Bitcoin and many of these digital assets, but we can shut our citizens off from it.
Yeah, so that's an interesting point. I'll try to combine a couple questions here back to Lyn on that. Number one, do you see, following up on your comments of these assets that are nobody else's liabilities, do you see a first soon, maybe this year or next, of a central bank actually making a purchase of Bitcoin for that reason? And number two, how do you view governments and regulation in general coming to grips with this technology?
So I think, whether it's a government entity or a corporate entity, there's a lot of career risk in terms of deciding to buy Bitcoin, add it to your balance sheet in various ways. And so you start to see it on the periphery, right? So you see, for example, MicroStrategy, has key ownership by the CEO, very long-term CEO. He's able to think past a quarter or two. He doesn't really care about the career risk. He really kind of, is making a judgment about the long-term company itself. And so you're more likely to see those kind of decisive moves from entities like that. When you bring up the El Salvador example, that's, basically less to lose, kind of, an interesting gambit to say, okay, there's some risks here. We've seen, for example, El Salvador sovereign bonds have been pressured over the past year. But on the other hand, their tourism is up dramatically, and we're kind of seeing how this experiment's going to work out for them. But it's basically it's a smart gambit to make if you're in one of those kind of smaller or more periphery or if you have more control and less career risk. It gets harder when you go up the spectrum because you're talking about Bitcoin itself is less than $1 trillion market cap at the moment. It's very volatile. So if a large central bank announces that, they're likely to get pushback in many ways. And so I do think that over time, you'll see probably, if Bitcoin continues its trajectory, right? So if it goes from, say, a $1 trillion market cap to a $3 trillion market cap to a $5 trillion market cap, if it's owned by, goes from 2% of the world population owning some to 5% or 10% or 20%. And as it, when Bitcoin is a 26-year-old asset as opposed to a 13-year asset, and it's survived more attacks, if it has, right, that becomes a different discussion than the discussion right now. So in many ways, it's still premature for large central banks, but it's something that, countries on the margins, I think, are taking a serious look at and saying, okay, well, let's watch what happens with El Salvador and say, should we do that as well? What if we, a lot of the companies, for example, don't do what MicroStrategy did, where they put all of their reserves in it, but you have, say, put 3% or 5% of their reserves in it. And so I think you could have some central banks do things like that, where they take that risk in that regard. But I think, in many ways it's still premature. But I'm long-term bullish on adoption in various ways. So different types of pools of capital, corporate balance sheets, just the tendency to include it as a slice in a portfolio. A number of people in countries wanted to self-custody it for various reasons related to the, maybe how, to what extent they question the rule of law in their country. And so I think across multiple dimensions, it still probably has structural adoption ahead of it, as long as it avoids major tail risks related to bugs, related to, other things like that could derail it from this structural trend it's been on.
Yeah, so I think we have time for one more question. So following up on that, we've seen Bitcoin go through many narratives, and Bitcoin is what it is. It hasn't really changed, but we as humans, we build narratives around investment thesis, right? So we saw a lot of interest around the narrative as a payment system, the rails, right, replacing Visa, MasterCard. And then as people discovered more, that wasn't the killer use case, right? Now we're seeing it move to store of value, potential hedge of inflation, and ultimate digital monetary good, which is what we've centered around on our paper here. Do you think that narrative continues, or are we seeing a new narrative emerge? And I'm, again, combining some questions here from the Q&A on Bitcoin's censorship resistance, permissionless architecture, and how it can be used for, say, both good or bad ways to evade certain regulations or sanctions or things like that. Is that what's going to emerge this year, in your opinion? And do you think overall that's going to help or hurt the narrative?
So I think both, and that's a key risk reward to watch. And a comparison I've made before is to pagers or beepers, right? So when they came out and they started being used, they were used by doctors on one hand, right? They want to, if their patient is going into delivery, for example, the doctor needs to know that. On the other hand, they were actively used by drug dealers, right? Because both parties had an incentive to adopt this new technology, right? And so the technology itself was neutral. It was something that, it's out of the box now. We know how to make it, and there are going to be good actors and bad actors use it. And so I as a digital commodity, right? So just like any commodity, right, can be used by good countries and bad countries, kind of like how the internet can be used by good people and bad people. I view Bitcoin, because it is sufficiently decentralized and censorship resistant, that unfortunately means it can be used by bad people, right? But it can also be used by good people. And so, for example, you have people like Alex Gladstein of the Human Rights Foundation cataloging all of the ways that it's being used by people for good purposes in various countries to protect themselves and to help with human rights. But on the other hand, you can have countries like North Korea or Venezuela or Russia, a spectrum of different countries use it for their purposes as well. And I do think that in addition to scalability, one of the challenges Bitcoin's base layer has is related to privacy, which can affect how censorship resistant it is and what trade-offs it makes around that. And so I do think going forward, privacy, the ability to go around sanctions, censorship resistant in general, the legality of encryption. That was already a big debate over the past couple of decades. Is should citizens be able to use encryption among themselves? What rights do they have to privacy? And I think this is yet another layer that ties into that broader discussion. about access to privacy, access to basic transactions, and I think that is going to be both a use case for why it's useful, as well as getting pushback among people that are opposed to that. I think it's both a risk and a reward long term.
Great. Well, Lyn, thank you. This has been amazing. You've brought your class, your knowledge, your insights to all of us here, and we certainly appreciate it. Thank you again. Check out Lyn's work, and please stay on for just 30 seconds here as we close this out to fill out that survey for us. It would help us out a lot. Thanks, everyone.
Thank you.